People keep talking about set-off. What does that actually mean?
Set-off means that you are able to tell the taxman that before you pay a tax on your capital gains, that you have some capital loss as well. So you want to reduce the capital loss from the capital gain and pay tax only on the net amount. So you will be able to reduce your tax liability by taking the benefit of set-off. This is allowed under the tax laws.
And what if I'm investing in a mutual fund? Am I eligible for a set-off then?
Yes, you do, because in a mutual fund you will be able to have capital gains as well as capital losses, and when you have a capital loss you can carry this forward for a period of 8 years and you will be able to reduce your capital gains and pay a lower tax. So set-off benefit is available in a mutual fund as well. However, there is a small point to remember here, because when a dividend is paid, the mutual fund's NAV falls. The taxman is not going to consider such a drop as a capital loss. So if you bought a mutual fund unit, you have to buy it 3 months before the dividend and you should be selling it 9 months after the dividend to be able to claim any set-off benefit for any fall in the NAV. So a fall in NAV just because a mutual fund issued a dividend is not going to be treated as a capital loss and it won't be eligible for any set-off benefit.
Are there any specific rules for set-off?
Yes, there are, because capital gains can be short-term as well as long-term.
Right.
Now we all know very well that people tend to trade on securities a lot and they keep making short-term gains and losses on an everyday basis. So assume that someone actively trades and keeps making quick losses every day, but then he says, I'm going to keep this loss and set it off on any other long-term capital gain that I make and I will pay lesser taxes. So tax rules are very clear about how set-off provisions will work when it comes to short-term capital losses and long-term capital losses. So if you made a short-term capital loss, the set-off benefit is available against a short-term loss as well as a long-term loss. But if you made a long-term capital loss, it can only be set off against a long-term capital gain.
Okay.
So you can't take a long-term capital loss and come and set it off against a short-term capital gain, because the taxman wants to recover the gains or the taxes that are available on your quick trading activity. He doesn't want to let go of that.
Okay. So, what if I've made like a long-term capital loss in an equity fund? Can I actually set it off against a long-term capital gain, say in a debt fund?
Theoretically, the situation is right, because you have a long-term gain and you have a long-term loss. So you should be able to set one against the other.
Correct.
But we must remember that long-term capital gain from equity is exempt. So because the gain under that category is already exempt, there is no question of getting a benefit of set-off on a loss. So if you sold an equity fund and you have a loss, there is no set-off benefit available to it. So you can't set off that loss against any gain you make under any other category of funds.